We're going to start with how money is created in a modern economy, the fundamentals of it, and then we'll be referring to the latest two crises to explain how relevant this topic is to understand the relation between money and inflation and how both central banks and commercial banks are critical. The understanding on how they make a decision is critical in order to analyze inflation and the business cycle. At the end of the presentation, I will just spend a few minutes on some of the programs we have at the University of Buckingham, specifically the postgraduate programs in this area, money, banking, central banking, and the government. So I will be speaking for 20-25 minutes. We'll be having 15-20 minutes for Q&A. The first thing that I would like to discuss is a couple of myths we should debunk straight away. The first one is that money doesn't grow on trees. No, it doesn't. It's not free. It should be scarce, actually. For money to display the properties that it should have, it should be limited. That's one of the things that we've learned over the centuries. This is not just a 20th century lesson. It goes far beyond that. So if we have too much money in the economy, that's not going to be neutral. That's going to be eventually inflationary. Money, as I said, is not free. It should be scarce. Another myth says that the money that we use in modern economy is mostly produced by the central bank, by the Bank of England in the UK. That is not the case. In normal times, the Bank of England does not create all money in the economy, only a tiny fraction of it. Does it mean that the Bank of England has no power or has no influence as regards the amount of money in the economy? No, it doesn't. It has a great influence on how much money there is in the economy, but it doesn't create all money in a modern economy. And actually, when people refer to the printing press and they say that the Bank of England or the government is printing too much money, that's not accurate either. They don't print money. Money is printed by other institutions in most countries. And actually, the amount of money printed, the amount of notes in circulation is really, really little, really, as compared to what we call electronic money, which is the vast majority of money used in a modern economy. What unfortunately is not a myth, and is actually very, very true, is that the Bank of England or any other national central bank, they can create as much money as they wish. That is true. In modern monetary systems, there is no theoretical or practical, if you like, limitation on the ability of the central bank to create as much money as they wish. This is the reason why this is such an important topic, because we need to find the policy tools, the institutions to limit that ability, to restrict the ability of the government or the central bank to create money. So which are the fundamentals as regards the creation of money in a modern economy? I will devote a few minutes to this, and then, as I said, I will be applying those fundamentals to the understanding of the latest two crises. First of all, we are living in what we call fully fiat monetary systems. By a purely or fully fiat monetary system, what we mean is that money is just imposed by the government by decree. That's what fiat means. It's just a government imposition on the citizens. That's what it is. We don't choose what we use as money. It's given by the government by fiat, by decree. So theoretically, there is no limit on the ability of the government, either directly or via the central bank, to create as much money as they wish, because there is no metallic base, there is no metallic backing of money. It's just printed, as they say, or created electronically by the national central bank. And this is precisely, as I said, we need effective binding policy rules to avoid the production of too much money. And that money, the one created by the national central bank, you can say that is created out of thin air. Precisely because what I said, it is not backed up by any asset, by any precious metal, such as gold, for example, at the time of the gold standard, or silver, or any other limited asset. It can be created out of thin air by the national central bank. The situation was very different in a very different under a very different monetary standard, the gold standard, for several centuries in the UK and for several decades in many other countries back in the 19th century up to the outbreak of the First World War. During the classical gold standard period that goes from the 1870s to 1913, the operation of the gold standard was very transparent and very much understood by the public at the time. Here you have an excellent, a beautiful caricature by James Gilray from depicting a time before the classical gold standard, but indeed the gold standard in the UK, in England, at the time of the wars, the Napoleonic Wars, at the end of the 18th century and the beginning of the 19th century. This one is from 1797, and it's depicting the power of the sovereign. Well, in this case, not the sovereign, it's the prime minister, the executive, the government, William Pitt the Younger, to create money under the gold standard. So as you can tell here, this gentleman, the prime minister, is holding the gold reserves of the country. That's in the belly of the prime minister, and is transforming those holdings of gold into paper money. So it is, as the title of the caricature reads, his Midas in reverse is transmuting all into paper. Everything he touches is transformed into paper. But of course, this gentleman had to be careful as to how much he was printing money, because there had to be by law a correspondence between the total amount of notes printed by the bank and the total value of the reserves held by the Bank of England. Why? Because as you can tell here at the bottom of the slide of the painting, money holders could go back to the Bank of England and exchange a note for the equivalent amount of gold at the existing parity. So the Bank of England had to convert every paper note presented to the bank at the existing parity in gold. Indeed, this convertibility rule imposed a very effective limitation on the ability of the Bank of England to create money. Nowadays, money is different. We have notes, and still we have, under the Bank of England title here at the top, there is a very little small print line here reading, "I promise to pay the bearer on demand the sum of," in this case, £50. This is a relic from the past, a relic from the gold standard period, because indeed it was a promise to pay at that time. Now, I'm afraid if you take this note to the Bank of England and present it and ask for the equivalent amount of gold, they wouldn't give you any gold. Don't expect it, but maybe another note. That's the best you can do. But again, it's a relic from the past. Nowadays, we have fully fiat monetary systems, as I said, and they are not backed up by any precious metal. Who benefits from this system? Well, the one benefiting from this system is the issuer of the currency. So it's the government, ultimately. The government owns the Bank of England. The Bank of England is a state-owned bank. So who receives the profits from making money? What we call seigniorage, the government. Seigniorage is the difference between the total value, the total nominal value of the money printed by the Bank of England and the cost of production of those notes of the money printed by the Bank of England. The cost of production of a note, the average cost of production, is something between 6 and 8p, so less than 10p per note. So if you just do the maths, 50 minus 10p, well, that's quite a margin, isn't it? Times the total volume of notes issued in the country, that gives you a meaningful seigniorage that indeed is for the government. But who else creates money in a modern economy? The majority of the money that we use in a modern economy is created by commercial banks, by the banking sector. Every time they give a loan to an existing customer or a new customer, or whenever they buy an asset from a non-bank, they create a deposit. And that deposit is bank money, is money ready to be used. So bank money is also created ex novo, as we say, so out of nowhere, by the banking sector. But there is a difference here as regards the money created by the Bank of England. With bank money, commercial banks, they can create money, but they are constrained by two limitations. One, they must hold enough capital in the books and enough liquidity. Those two requirements apply to the banking sector, but they don't apply to the Bank of England. So indeed, they have quite a lot of capacity to create money, but it's not unlimited. The way they do it, as I said, is every time they lend money, they create a new deposit, and that's money. And they don't even need to wait until they receive more money from the customers in order to channel that excess in deposits throughout the system, throughout other customers. They don't do that. They can create the money in the first place. They just decide to lend money. They just do it. And whenever they lend money, as I said, they create a new deposit. And in order to fulfill those liquidity standards or liquidity requirements that I referred to, afterwards, what they do is to try to find the ways to cover for the reserve for liquidity ratio, as we call it. Effectively, is to have enough money to pay back the depositors' money. How do they do it? Attracting new deposits from existing or new customers, asking other banks for lending. They go to the so-called interbank market to ask for a loan. And as an extraordinary resource, they can ask for a loan from the Bank of England, from the central bank. So just to summarize, in a modern economy, we have different types of money. This is what we call monetary aggregates in the jargon. We can make a distinction between two different types, narrow money versus broad money. By narrow money, I mean the money created by the Bank of England or the National Central Bank. What do we include in narrow money, which is also called the monetary base or M0, is cash in circulation plus bank's reserves at the Bank of England. That's it. That's what we call the liability side of the Bank of England's balance sheet. Is this a lot of money in the economy? Not really. It represents normally 5 to 10% of the total amount of money in the economy. The rest of the money that we use is what we call broad money. In the UK, there are different monetary aggregates depending on the number of deposits included. It goes from M1 to M2, M3, and M4. In the UK, the broadest definition of money is given by M4. And it's made of cash in circulation and critically, this is the difference, plus bank deposits, the money we, households, companies have in the banking sector. And this is indeed the money we use normally to pay in the market. Whenever we go to a cafe and pay with our phones, with our debit cards, whatever we order, we pay with a transfer, for example. What we're doing is electronically is to order our bank to mobilize our deposit and to pay it into somebody else's deposit. And that involves no Bank of England money, no notes. So that's the bulk of the total amount of money used in modern economies is indeed the liability side of the banking sector's balance sheet. And as I said, represents from 90 to 95% of the total amount in circulation. But there's a caveat to this. In times of crisis, central banks have a major say as to how much money there is in the economy. They can be very influential as regards the amount of money in the economy. Remember that central banks, and indeed the Bank of England, but many others, they were created to assist the government in times of crisis. That's how the Bank of England was established in 1694 to support the Crown to pay the war with France, another war with France at the time. So the Bank of England at that time was given a monopoly power to issue notes along with other privileges. And in exchange, the bank lent money to the government, to the Crown, to the government in order to pay for the war with France. That's why it was from the very establishment the bank of the government. And now it's much easier. Now they don't even need to ask for money. With QE, with quantitative easing, that's something I'm going to discuss now. The way central banks intervene in times of crisis very much makes it much easier for the government to pay for the deficit, to finance the debt. You have here another cartoon by the same artist, James Gilray, representing the same prime minister at that time assaulting the old lady. The old lady is the old lady of Threadneedle Street. That's a nickname after this caricature, the nickname of the Bank of England ever since. And is the Prime Minister, well, taking the money from the bank. What they did effectively is to assault the bank, is to take over the bank, to take over the power of printing money, suspending the gold standard and printing money in order to pay for the war against France. Was that inflationary? Yes, it was inflationary, but it was an extraordinary circumstance justifying the government intervention of the Bank of England. How do central banks create money in times of crisis? Well, first we're going to discuss how they do it normally, in normal times, if you like. In normal times, what they do is to provide regular lending to the banking sector. What they provide is short-term lending over 1 to 2 weeks. What they do is what we call open market operations. So here you have the Bank of England on the left-hand side, creating new money because they can do it, as I said, as much as they wish, in order to lend it out to the commercial banking sector, Bank A, B, C, whichever. In exchange, the Bank of England will be asking the commercial bank to show enough collateral to back up the lending. That collateral usually is a public bond that acts as a guarantee of this lending operation. So just for the duration of the lending, the Bank of England will be holding those assets as a guarantee in exchange of the money lent to the commercial bank. After 1 or 2 weeks, the operation will be reversed. That's why we call it a repurchase operation. The operation will be reversed at maturity. The bank will be paying back the principal of the loan plus an interest rate and interest payment. Which interest payment? That's determined by the policy rate set up by the Bank of England. This is the rate that we hear in the news when the Bank of England, the Monetary Policy Committee, meets every 6 weeks and determines that the policy rate in the UK is going to be X%. That's the rate at which they lend out money to the banking sector. In crisis times, what they do is to provide extraordinary lending facilities to banks. So open market operations to the power of 10, if you like, or 100. More money lent at much lower rates and much long-term loans. So basically, it's just the expansion of loans and on top of that, asset purchase programs, what we have been calling quantitative easing. This has been a novelty over the last 20 years, and it's worth discussing it in more detail. With QE, with quantitative easing, what central banks do, again, or should be doing in times of crisis, is to purchase an asset from the bank. So now it's the Bank of England buying, not lending, buying an asset from a commercial bank. Which asset? Normally a public bond, a gilt in the UK. So the gilt goes from the balance sheet of the commercial bank into the balance sheet of the Bank of England in exchange of newly created money. This is not a loan. It is not meant to be reversed, or it doesn't need to be reversed. It's an outright purchase. So the Bank of England will be paying the commercial bank in the bank reserves account at Bank of England, and that will be increasing the monetary base in the economy. There is another type of QE, one in which the Bank of England is buying an asset, a public bond, now not from a bank, but from another non-bank financial institution. An insurance company, for example, could be. And what the bank is doing now is creating new money to pay for it and will be paying the non-bank financial institution into the preferred bank account. And remember, a bank deposit, a bank account is included in a broader definition of money in M4 in the UK. So again, a very different operation in nature. This is not a loan. It's much more permanent, if you like. It's an outright purchase of an asset. Which asset? Public bonds. How active the Bank of England has been over the last 2 crises? Well, as you can tell, before the autumn of 2008, there were no asset purchases. Asset purchases are represented here by this yellow area. There were none before that, and they have become very, very prominent ever since 2008. So you can tell this increase from 2008 to 2016, then again up to the COVID-19 crisis, and then again a big jump here with COVID-19. Have all these QE operations been inflationary? No, not all of them. These first operations from 2008 to 2012 were not inflationary because they resulted in an increase in bank reserves at the Bank of England and not really in the amount of money available in the economy, not really in broad money, as I explained it before. Was that inflationary? No, it was not. However, this time around from February, March 2020 up to 2022, this vast expansion of key operations indeed have been inflationary because they have increased the monetary base in the economy, but also bank deposits. And that's what determines inflation over time. So it has indeed been inflationary. Let me use another example, the global financial crisis, as a case study. Here you have the data for the US. The solid line corresponds to a CPI rate of inflation, the consumer price index rate of inflation. And the gray area corresponds to the monetary base, the money created by the Federal Reserve in the US at that time. As you can tell, from 2008 and onwards, there was a huge explosion in the amount of money created by the Federal Reserve System. Was that inflationary? Not really. Inflation decelerated and even contracted. So indeed, deflation for a couple of terms in the US in 2009. So as you can tell, there is no a relation between the expansion in the monetary base and inflation. What it really happened is that now you have the monetary base expansion here, the solid line. But what happened to bank deposits, broad money? In America, this is measured by M2 or M3. Broad money, this is this discontinued line here, decelerated and even contracted. So it was the contraction in bank deposits what explains the disinflationary and then deflationary patterns in the US at that time. That's why it's so important to understand how money is created in a modern economy and what is narrow money versus broad money. How about in the UK during COVID-19? Well, here you have the rate of growth of broad money, M4. It was fairly stable from 2014 all the way up to 2019, fairly stable around 4 or 5%, which is a very sound rate of growth of money, compatible with a 2% inflation target. And then you have this jump here from 5% to up to 15%. So in 1 year, the Bank of England managed to increase the amount of money 3 times more than normal. Remember, they can do it. There is no limitation on the ability of the Bank of England or any other central bank to do it. Was that neutral? No, it was not. It produced a surge in inflation 1 or 2 years later, 2022 and 23. And this is what we explained by the relation between the amount of money in the economy and inflation over time with the quantity theory of money. This is something that we very much address in our courses. Just a reminder on how important it is to limit the ability of central banks to produce money. Here you have the rate of growth of our prices, inflation over the centuries in England in a very long-term perspective before, well, since the 1750 all the way up to 2012. After the Napoleonic Wars, indeed inflationary. That's an extraordinary time. So as I explained before, the government asked for support from the central bank to pay for the wars, and it was indeed inflationary. But right after the war, exactly from 1813 up to 1913, you can tell there was a period of stability, especially towards the second half, of the 19th century. Actually, if you do the maths, the value of the consumer price index, so the average of how much a representative family would have spent in their groceries, if you like, back in 1813 would be roughly, if not exactly the same as that 100 years later in 1813. That's how stable prices were over a period of 100 years. There were periods of inflation followed by periods of deflation and a mild deflationary trend at the end of the 19th century. But indeed, overall, a period of price stability. That was very much under the running of a very successful regime, the gold standard. Then, of course, we have the two major wars and monetary expansion in order to pay for the wars. What is not normal is what happened after the wars. Since the 1960s and 70s onwards, we saw again an acceleration in inflation. You see that we have managed to contain with the adoption of policy rules, inflation targeting in the UK in the 1990s, 1992 and onwards. But nevertheless, there is an inflationary drift in the system. This is why this diagram, I think, summarizes very well why it's so important to impose a limitation on the ability of the Bank of England, or if you like, the government, taking it broadly, to produce money, because we want to maintain the purchasing power of the currency. This is something, this topic and many others that we cover in our masters. We just launched a new MA in money governments and central banks that is fully delivered online. It's a one-year master's by research. We have a series of webinars throughout the first two terms, and it is very much based on the supervision of the master's thesis. And the topics that we cover is very much the relation between money and inflation, bank regulation, how bank regulation affects the ability of banks to create money, and indeed the relation between the central bank and the government. Another major topic is crisis management by central banks. How should central banks intervene in times of crisis? We offer a series of scholarships. If you're interested in learning more about the program, all the scholarships, please let me know. Some of them are specific to these programs, are the Condon scholarships, and they represent, well, roughly 50% of the fees of the program. So I would very much welcome applications for the September entry. We have other shorter programs, such as this short course, professional course on money, inflation, and monetarism. This is one of the few, if not the only one really, in the UK covering monetarism, the relation between money and inflation over time. So how changes in the amount of money affect inflation and the business cycle. It's based on a series of pre-recorded video lectures by Professor Condon. And it's a very short course, 12-week course that you can take it as the credit-bearing version or no credit version. And indeed, it opens up in September as well. If you have further questions about these programs or any other, please contact the university at info@buckingham.ac.uk. And if you have specific questions about these topics, the topics we've discussed today, well, more than happy to take your questions now or to be in touch with you by email. Here you have my email address, juan.castañeda@buckingham.ac.uk.